Index funds are some of the most powerful investments that anyone can have. They're extremely easy to manage and have been proven to be successful and turn many everyday people into millionaires. Arguably the best investor of all time, Warren Buffett, has stated many times how he feels about index funds, saying a low-cost index fund is the most sensible equity investment for the great majority of investors. So in this video, I'm going to give you a step-by-step walkthrough about investing in index funds through Fidelity. Even if you feel like you don't know anything now, you will leave this video being confident, knowing what to invest in and how to invest into index funds. So what are index funds? Index funds are pooled investments that are designed to mirror a stock index. So what's an index? So an index measures the performance of a group of assets for a certain area of the market. Now this could be a broad market index like the S&P 500 or the Dow Jones Industrial, or a more focused index that focuses on a particular part of the market like the Russell 2000 index, which focuses just on small cap stocks. So the goal of each index fund is to match the stocks and the weight they carry of the stock as closely as possible in order to get about the same returns as the index itself. Now when looking at index funds, what's the best criteria to know if you have a good index fund or not? So the first thing, and probably one of the most important things, is the expense ratio. An expense ratio is a fee that comes out of your investment, and it usually comes as a percentage. So this is the fee that you will pay annually to the fund. So the smaller the expense ratio, the smaller the fee that you'll have to pay each year to invest into that fund. So when you're first starting out, looking at the expense ratio and tracking these expense ratios might not really seem like a big deal. But as I mentioned, this is a percentage of your investment. So as your investment starts to grow and compound over time, the expense ratio becomes more and more important. Now every index fund will have an expense ratio, even though these are passively managed. But the fund manager is still doing the work of composing the index fund and maintaining the index fund. By passively managed, I mean that the fund managers aren't actively picking stocks and trying to beat the market. Instead, their goal is to match the market and not try to outperform the market. So with an index fund, the fund manager's job is really just to maintain the holdings and keep it on track. So what's a good expense ratio? For index funds, since they are passively managed, you want to get an expense ratio as low as possible. So anything at 0.2% or less is great for index funds. So let's look at the Fidelity 500 Index Fund, or FXAIX. You can see that the expense ratio is 0.015%. So if you invested $1,000 into this fund, you would only have to pay 15 cents per year. Super cheap. But if you invested that same $1,000 into the Matthews Emerging Market Fund, you will be paying $14.90. As I mentioned before, it might not seem like a big deal right now just thinking about $1,000, but imagine if you had $100,000. You will start to feel some pain with these high expense ratios. Check out this chart given by the SEC to see the long-term difference that fees can have on your overall account and you building wealth long-term. You can see the difference between a 1% annual fee and a 0.25% annual fee can have a difference of $30,000 over 20 years for this size portfolio. So looking at index funds, if you see an expense ratio higher than 0.2%, don't look any further. So to find the index fund, you will go to Fidelity. You just type in the ticker and you'll see this window open on the side that will give you some very general information about the fund itself. Now you'll see two numbers. You'll see a gross expense ratio and a net expense ratio. Now you may be asking, what's the difference between the two and which one should you look at? Well, the gross expense ratio is the fee for all expenses for the fund. This includes the fees that are paid to the fund managers, administrative costs like maybe office buildings, marketing costs, employee salaries, and other fees related to the fund. Now the net expense ratio, now this is the same amount of fees but at a discounted rate. Sometimes funds give a discount as far as the expense ratio to attract more people into the fund. Now many times you'll see that the gross expense ratio and the net expense ratio are the same, but sometimes they won't be. If they aren't, it's best to look at the gross expense ratio just to be safe, because discounts don't last forever. So even though the net expense ratio is what you're paying today, the gross expense ratio is something that you could be paying in the future. So just to be on the safe side, take into account what you could be paying as a worst case scenario. Another criteria is reinvested dividends. Now dividends are a distribution of a portion of the fund's earnings or the income that's paid out to shareholders. So since the index fund holds companies that pay out dividends, the index fund would also receive dividends. But the good thing about index funds is that those dividends are reinvested into your account automatically. So with the dividends being reinvested into your account, you start to see a bigger impact of compounding and growth of your account over time. This chart shows the difference of reinvested dividends in the S&P 500 from 1993 to 2017. So if you invested in the S&P 500 index funds in that same time period, your account will see a very similar type of growth. Now you can see just the difference that it has by reinvesting your dividends instead of taking it out in cash. So when looking at index funds, you can go to this tab here. You can see if dividends are distributed in this index fund, and if so, when these dividends are reinvested into your account. So if you look at these dates, you will see that these are paid out quarterly for this particular index fund, and you will see these same payments back into your account at these same dates for reinvesting into this fund. The next thing is the date of inception. The date of inception is the day that the fund was created. Now generally it's better to invest into funds that have at at least 5 years since inception. Buying a fund that is very new is kind of risky. You can compare it to buying a new model for a specific car. Buying it the first year is generally not a good idea. Yeah, you may have the nice new car. Yeah, it looks fun and it looks nice. But then as years go on, you'll see that this new model has some issues that they really had to work out over the years. So by looking at a fund that has at least 5 years since inception, you can look at the data and see how it performed over specific market conditions. You can also get a sense on how its performance is overall and how stable it is. Next thing that the date of inception will tell you is how closely the index fund matches the stock index that it is composed of. As you can see, between this S&P 500 and the Fidelity S&P 500 index, the returns on both of these are almost identical, and this is what you want to look for. Now, what are the best index funds to invest into? This isn't a definite list, but I'm going to give my opinion on the best index funds depending on whatever category that you're interested in. And then you can look further to see if it matches your goals and what you're trying to achieve. You can also get more information on these index funds at a video that I'll link at the end of this video that will break these down into further detail. Now, for domestic stocks, you can look at the S&P 500 index fund or the Fidelity Total Market Index Fund. For international stocks, you can look at the Total International Index Fund. And for bonds, you can look at the Fidelity US Bond Index Fund. As I mentioned, these are very general recommendations, but these are great options to get started. Now, to buy index funds, it's actually very easy. To fund your account, you set up your bank and you link it to Fidelity, and that way you can wire transfer money from your bank account to your Fidelity account. Usually it takes about 3 business days for this money to clear, but with Fidelity, you don't have to wait to buy into index funds as your funds are clearing. For example, if I make a deposit on Monday and it takes up to 3 business days for me to clear those funds, I can still buy into my index funds on Monday, as long as I don't sell any of my purchase by the time my funds clear. This is a lot of SEC rules and regulations and things like that. You could get penalized if you start to sell investments that haven't been cleared yet. But we're investing for the long term anyway, right? So this shouldn't matter. So as soon as you deposit your money into the account, you should see it as pending and you can still make your purchases there. So to buy, you just type in your ticker symbol and then you can decide how much you want to buy. The good thing about index funds is that you can buy based on dollar amount compared to individual stocks. So for example, if an Apple share costs $150, you can't buy into Apple unless you have at least $150. But with index funds, even if you have $50, you can still buy into that fund. Now, once you see how much money you have in your account, how much you want to invest, now you want to see how you want to allocate this money based on your goals and your risk tolerance. You will hear many different opinions about allocation as far as how much you should invest in domestic stocks and how much you should invest in international stocks and bonds. But the most general opinion is that you take your current age and that is the percentage that you want to buy in bond index funds. You take the difference of that and you can invest into domestic stock index funds. So if you're 35, you will put 35% of your money in bond index funds and 65% of your money in stock index funds. Now, this was recommended by Jack Bogle, who is actually the founder of Vanguard, but I'm going to have to disagree with Jack just a little bit on this. This is a very general recommendation. In my opinion, it's pretty conservative. If you're 30 years old and you already have 30% of your money invested into bond index funds, it's going to dampen your possibility for really growing your account towards retirement and as you get older. Since bonds are considered a security investment, you can't expect to make a lot of profit or a lot of gains from it. The bonds are really just to protect the investment and to protect the gains that you've made in the previous years. So if you're a little more aggressive or if you're on the younger side and you want to be more heavily invested in stocks, another good option is to take your age and you subtract that by 120 instead of 100. So if you were 30 years old, you subtract that from 120 and that would give you 90% of your portfolio in the stock index funds and 10% in bond index funds. So if you invested $1,000 into your account, then that means you could put $900 in a Fidelity S&P 500 index fund and 10% or $100 into a bond index fund. You will also see some allocations that take into account as far as international stocks and real estate, and everybody has an opinion, but these two options are the most basic and the easiest ones to get started. Once you get your feet under you and once you get going, then you can start venturing out and seeing other type of funds that you want to mix into your portfolio. But honestly, the allocation, it does matter, but it doesn't matter as much as being consistent and investing into these funds over a long period of time. You can't expect to invest and your life change in 6 months. You have to be steady and disciplined, and if you can do this, you'll be surprised at what your account looks like as time goes on and as it starts to build. So if you haven't started investing yet, it's very easy to open up a Fidelity account. It's very easy to get started investing, and you need to do that today. But if you like more detailed information on some of these funds that I get into the expense ratio and the stocks that they invest into, then you can check out this next video. Other than that, thank you for watching. See you on the next one.